other semesters, it's still there.
Okay.
Yeah, and there's keeping it back. I didn't cover much anyway, so probably earlier semesters would have been better.
Okay.
Yeah, so it'll be all right. Okay, anyway, so you want to do periodic versus perpetual? Real quick? Okay, what's the deal with periodic? You periodically count the inventory. What's the deal with perpetual? You perpetually keep track of how much inventory you have, and you still periodically count it, though. Okay, because if you don't count your inventory, then you're totally trusting your records. Have you guys worked in an environment where inventory is coming into a store and going out of a store?
Yes.
He's doing that, yeah. Does it ever get screwed up? You know, the inventory records? You know, like you don't keep track of what comes in properly, you don't keep track of what goes out properly. Things get, you know, a forklift drives over some product and the forklift driver throws it in the trash can and doesn't tell anybody because they don't want to get in trouble. Or it's stolen, right? Stuff is stolen. That nobody ever steals anything and runs by the checkout stand and says, hey, update your inventory records, I'm stealing this, right? Yeah, that doesn't happen. So your perpetual inventory is not going to be real accurate necessarily. You try to keep it as accurate as possible. Okay, so you still have to count it. All right, anyway, but the accounting is going to be a little bit different, okay? So you got the idea, you two, slackers, not kidding, right? Okay, you two and everybody else has the idea of what the difference is between perpetual and periodic, right? Periodic, I periodically count. Perpetual, I perpetually keep track of it. Okay, so let's do a purchase, okay? So if we were to purchase, oh, geez, don't change on me again. I'm touching something wrong somewhere. I got it, okay. I think I need one more step. I think I need to touch it at the top, too. Instead of just setting the pen down. I think I might be doing it myself. Okay, anyway, so let's do the two of them. Let's do what the journal entries are. By the way, perpetual is what we did in principles the whole time, and then we just added periodic at the end, okay? Most companies do perpetual anymore. Why? They have, it costs more to do perpetual, but if you have computers, it doesn't. Right? All of a sudden it doesn't. And you have far better control with perpetual. You know how much you're supposed to have. You keep track of it all along. Okay, so let's buy something. Let's say we buy $100,000 of inventory. What would the journal entry be under perpetual? I perpetually keep track how much inventory I have, so when I buy inventory, I debit inventory. Not purchases. That wouldn't keep track of how much I have. In the inventory account, I want to know how much I have. That's it. So, good, we're covering this. Inventory. So, what did I say, 100,000? And typically I'm going to pay later, right? Business to business, credit accounts payable. Then when I pay later, I debit accounts payable and credit accounts, right, guys? Okay. Periodic, what would you do? Now you use the purchases account. Okay? Which is kind of an expense account, okay? It's going to be on the income statement. It's an expense account. It's going to help you calculate cost of goods sold in the income statement. Okay? Purchases and accounts payable. And then when you pay it, debit accounts payable, credit cash. Everybody got it? Okay, now let's do a sale. Let's say let's sell 20,000 of that inventory for 35,000 on account. What would be your entry? Under perpetual. I said I sold 20,000 of that inventory for 35,000. Debit what? On account. Debit accounts receivable. How much? Credit what? Absolutely.
Credit, professional credit inventory.
Credit inventory, because I'm perpetually doing it, right? I want to keep track how much I have. So now I put 100 in inventory, I take 20 out of inventory, guess what? There's 80 left in inventory.
Cost of goods sold.
Debit cost of goods sold. So I am recording my cost of goods sold as I go. Another advantage of this, okay? What's my gross profit? 35 less 20, it's 15, right? We're on our way. What would you do under periodic? Better debit accounts receivable, and you better credit sales. By the way, what will I do with that later? Credit accounts receivable and debit cash. If you have sales discounts, returns and allowances, you have to handle that, right? Same thing on the accounts payable. If you have purchase returns and allowances or purchase discounts, you'd have to handle that, right? Okay, good. So let's say that's everything that happens in the company is their first year of operations. Tell me what they're going to have on their income statement. Oh, by the way, what would we do then? Let's do one other thing. So this is all that happened during the year. I only operated it a couple months. I bought 100,000 worth of inventory and I sold 20 of it. What do I still have left? 8. But I go count it, and I find out I really only have 79 left. I'm not happy. I have very good internal control. I've only been in business a couple months, and I lost 1,000 of inventory somehow, or I screwed up my inventory records by 1,000. So not good, right? I wouldn't like that. Okay. So either way, I'd go count. So I do the count at the end of the year, right? So we're at the end of the year. Okay, I do that count, and I only have, I expect to have how much left? 80, because I had 100. You think of the key account for inventory. I started with nothing, I got 100, right? And I sold 20, I expect to have 80. But then, and that's what's in my account if it's perpetual. What's in my inventory account if I'm periodic, of course? Nope, I put it all in purchases. Nothing. So inventory would have nothing in this case. Purchases would have the 100 in it. So what would be an inventory is the beginning inventory, whatever it is. Got it? Okay, so now at this point, I go count, and there's 79,000 of inventory left. What am I going to do? This is a good thing to cover, huh? Everything's a good thing to cover, probably. 79,000. What do I want over here? The periodic. 79,000. Oh, I bet there's a journal entry that needs to happen. If you've got 80 in the inventory account and you wish it was 79 because you went and counted what you had and you priced it out. Everybody with me? So what do I want to show on my balance sheet? 80 or 79? 79. 0 or 79? 79. How am I going to get there? I'm going to have to do what in the case of the perpetual?
Credit inventory.
Credit inventory for what? Okay, so I'm going to credit inventory for $1,000. What am I going to debit? It could be inventory loss. It could be, which is going to be other, right, non-operating income, non-operating revenue or expense, gains and losses. This would be loss, stolen inventory, right, lost inventory. Okay? It'd be a loss. Or if you think it's immaterial, what could it be? This could be inventory loss, loss on inventory, right? What else could it be? Cost of goods sold, right? If it's immaterial, you could just add it to cost of goods sold. Make sense? Okay. So let's say your cost of goods sold was 200,000 versus 1,000. You might just put it in cost of goods sold. If it's 20 and it's up to 20, that's pretty material. Okay. I don't disclose them separately. Make sense? Okay. Well, you know what? If I'm doing periodic, I don't know how much inventory I'm supposed to have because I didn't keep track of what I sold, right? So all I know is my balance is whatever it is. In this case, it's 0 because it's the first year, and it should be 79. What do you need to do? Debit 79. That's it. Debit inventory for $79,000. Okay? What are you going to credit? No, I'm not going to reduce purchases. But you could if you want. A variety of ways you could go.
Purchases is already expense.
Purchases is an expense, but if you want, you could close it to where? Cost of goods sold. So the way that would work is you would credit purchases for the 100. And what do we just make purchases now, you guys? Nothing, right? It's gone. So it's kind of a income statement account. But in this case, I'm closing it anyway, so it doesn't end up anywhere. Okay? So I get rid of it. Well, now what do I need? I need a debit for how much?
21.
And where would you put that under this approach? Cost of goods sold. So you know what? I don't know how much is cost of goods sold here. The whole 20 plus the one lost inventory ends up in cost of goods sold. So a big drawback of periodic is you don't know what was stolen or what was destroyed or whatever. Okay? Got the idea? But it's still, we end up with the cost of goods sold of what? 21, right? And here, if I'd have gone to cost of goods sold with it, if I thought it was immaterial, I'd end up with the same cost of goods sold either way, wouldn't I? You guys with me? All right, what is my cost of goods sold schedule going to look like? In both cases, what's cost of goods sold schedule going to look like on the income statement? Let's do that. Cost of goods sold. How do you do cost of goods sold? What do you guys do when you do cost of goods sold schedule? What do you start with? Yeah, in this case, nothing, but it's what? Beginning inventory. Whatever the beginning inventory is, this time it's zero. Beginning inventory, zero. Then what's the next thing you're going to put? Regardless which method you use. Purchases. And what are your purchases either way? I think it's 100,000 either way. It's how much you added to the inventory. In the case of perpetual, in the case of periodic, it's what went into the purchases account. What's available in both cases? Yeah. This is easy, isn't it? What's my ending inventory in both cases? What's my cost of goods sold in both cases? It's a miracle. Unless I separately categorized it as a loss, and then what would I have for my cost of goods sold? 20, but then what would I have down under loss? Another 1,000, so we get 21 anyway, right?
So,
That work?
is that the only time then, like if you categorize it as a loss, that the only time cost of goods sold would be different?
Yeah.
Okay.
You got it. The only time. By the way, what we could do, if we wanted, is instead of closing purchases, we could do an inventory change. We could debit inventory 79 and credit inventory change for 79, and then you'd close inventory change and purchases, right, to retained earnings, which is the same as now closing cost of goods sold to retained earnings. Because what am I going to reduce retained earnings by here? 21,000 when I close cost of goods sold, right? Okay. What if instead I closed 100 of purchases and 79 of inventory change account? The difference is still 21. Got it? So there's a variety of ways you could do this. Okay. They call that an inventory adjustment, by the way, on periodic. Right? All you're doing is you're adjusting the inventory from where it is at the beginning to where it is at the end. Key thing is, do you have to count the inventory either way?
Yes.
Yeah. Will you still adjust the inventory from where it is to where it should be either way?
Yes.
Yes. On perpetual, is it possible that your perpetual record's exactly right?
Yeah.
Yeah, sure it is. Probably if you're, buying and selling 747s, I bet it's perfect, right? I doubt if you lose one, right? If one gets run over by a forklift or something, probably not going to happen. If you're selling beer, I bet some gets stolen, right? And I bet some gets damaged and thrown away, okay? Sure, that kind of thing.
So, wait, what would you put if you counted and you had like 81?
Oh, just exactly the same thing. It just means you screwed up your recording of the inventory. You debit inventory and credit cost of goods sold for that error, right? Probably not gain on magically materializing inventory, but yeah. By the way, that almost never happens. People steal things, they don't contribute, right? Yeah. But you could have mistakes in recording it, of course. Didn't record all your cost of goods sold or something, or you recorded too much cost of goods sold, or too little purchases or too much purchases. All kinds of different errors. So did that kind of do it? We're good? Okay. Which method would you prefer to use in your company for better internal control? Perpetual always. What if you are selling something where you can't really track the inventory? I am selling corn that's still on the cob in the husk, and I pile it up out in, on my land in great big huge piles. Right? Do we have a barcode on each ear of corn? I don't think so, right? So what might you use? periodic. That might make a lot more sense for you, right? You might use periodic, count what you got, right? You know, estimate how much you have, okay? Anything like that. Commodities would always be this way, okay? So, but have you noticed even when you buy corn, if it's in a really good corn, you know, they'll actually have a barcode on it, a little sleeve on it, and barcode on it? No kidding, even do that, okay? But certainly if I'm selling a product that's in a package, are you going to put a barcode on it and use perpetual? Yes, because you can scan. Remember, we didn't used to have scanners. We used to have computers, right? So now anything that goes into a warehouse gets scanned in. Anything that leaves going through the check stand gets scanned out, right? Yeah. So with computerization, of course, perpetual is far better. Okay? All right. So let's do something else. Well, that didn't work. It's so strange. I had some setting screwed up. What do you want to do with that? What else do you want to do today? What kind of things? You want some dollar value LIFO? That'd be a nice idea. Did you practice those yet? Did you try it yet? Yeah, maybe. Let's take a look at one of the problems. Oh, by the way, in this chapter, this is towards the end of the chapter, they do dollar value LIFO, and it's back on page 435. Sorry. And here it's not too bad. But in the next chapter, we're going to have something called retail inventory methods, and they have retail dollar value LIFO. And it's really fun. That's why I like to cover it, make you do it. And if you were at most schools, guess what? They wouldn't bother, right? On the CPA exam, you might see a question or two on this kind of stuff. Your competition won't get it right, and what will happen with you guys if you learn it? You get it right. And they always ask easy questions about it, because they know almost nobody covers it, right? Okay, so, and you know what? It's kind of like, as we go through things, you know, a lot of times they'll say, well, nobody does this anymore, and then we find out, you know, that GE does, or Yum Brands does, or something, you know. Reversing entries is the one I was trying to think of. Nobody uses reversing entries, right? Just little outfits like GE, right? They do reversing entries. You can use it if you want. You don't have to use it if you don't want. Most schools don't bother to cover reversing entries anymore. So they're sort of primed for the CPA exam, because the people writing the CPA exam kind of know that. And not that they'll put a whole bunch on there. They'll just put a little on, right? And what score do you need on the CPA exam? 75%. What if you got 75 and you got 1 point because you knew how to do a reversing entry? What if you got 75 and you got 1 point because you knew what dollar value LIFO is? They wouldn't even probably have you calculate it, just you know what it is, right? Yeah, okay, so it's worth it, okay? Plus, they're kind of nice exercises in terms of thinking, right? And we go beyond the basics of the chapter. If you can do that stuff, you can do the basics, I bet you anything, okay? So let's take a look at who would use dollar value LIFO, by the way. And in the next chapter, we're going to have retail inventory methods. Let me ask you this. Off the top of your head, what kinds of companies would use a retail inventory method? And there are going to be 4 different ones, 4 different retail inventory methods. What kind of companies might use them? Maybe retailers. What do you bet? Okay, sure, retailers. What's the difference between a retailer and a wholesaler and a manufacturer? Manufacturer manufactures the product, right? Okay, they accumulate the materials, labor, and overhead, right? They build the inventory themselves, right? What does a wholesaler do? And by the way, that manufacturer could be a wholesaler, right? What does a wholesaler do? They sell product to retailers, to companies who are going to sell to the general public. Those are retailers. So all the stores you know, where you go to the store and buy stuff, what are they? They're retailers. They could be manufacturers who then sell it to you, but more likely, what are they? They're retailers who buy it from a wholesaler who buys it from the manufacturer, right? Okay, everybody got the idea? So a manufacturer could be a wholesaler selling to other companies. It could be a retailer selling directly to the public too, right? Okay, right? And then the wholesaler could be a manufacturer or not. They could buy from manufacturers, but they sell to who? To retailers, right? Could a wholesaler be both a wholesaler and a retailer? Sure, they could sell to other companies and then sell on to the general public. Got the idea? Could a retailer just be a retailer? Of course. Or could they be all three? Of course. Got the idea? Okay, so who's going to use the retail method? Obviously, retailers are. You know, Walmart could if they wanted, but they don't. Okay? That's because they're using perpetual. These would be people who are using periodic. Okay? So they're probably not computerized. All right? So what happens here? Do they know what the retail sales price is for all their products? You walk around in any store, can you find out what the retail sales price is for their product? Yeah, it's right on the shelf. That's how you know what you're going to pay for the thing, right? It used to be right on the can of green beans. They put a little sticker on it that told you how much it costs. They don't do that anymore. Now there's just a barcode on it. They don't put the price on it anymore. I think it's because they don't want us to know what the price is. You know, you buy a can of green beans, put it in your shelf in your cupboard, every time you look at it, you know how much you paid for it, right? So when you go buy a new one, it's gone up 20%, you'd realize that, wouldn't you? Right? But if they don't put the price on, will you remember what you paid last time when you buy the next one? They hope not. So you won't notice price increases. So Walmart can keep telling us they're lowering prices when they're raising them, right? Okay? They do raise prices, of course, with inflation. Okay? Right? And try to lower other ones, of course. Yeah, get more sales. But anyway, so we know the retail price by just looking at the shelf. Do we know the cost? Not by looking at the shelf. We'd have to go look it up, wouldn't we? So what might be more convenient? Value the inventory at retail and then estimate what the cost is based on that. Wouldn't that be clever? Because I could count my inventory, price it out, cost it out at the retail sales price, and then what I could do is I could just lower it down by my gross profit. That's all it amounts to, right? And I get down to an estimate of what cost is. That's what the retail method's going to do. Well, what's the case with dollar value LIFO? What's this one? I kind of like to use LIFO, right? Kind of like to use LIFO, but what's the deal? I'm not computerized. So this is dollar value LIFO. I want to estimate what LIFO would be without keeping track of the LIFO inventory. It's really expensive. Even if you are computerized, it's really a pain, right? You program the thing, right? Keep track of all the layers of LIFO inventory. So I don't have to. I just estimate it. So I treat the whole inventory as one big LIFO pool. All right? And then what I do is I adjust the inventory for the change in my price index. So take a look on page take a look at page 437. Page 437. Here they've got inventory at year-end prices. How would I get that? How would you get your inventory at year-end prices? In that first brown box at the top of page 437. How would you get your inventory at year-end prices? Count your inventory and figure out what and look up the most recent cost from your supplier and value it, right? Is that a correct valuation of your inventory? No, because you bought it earlier when prices maybe were less or maybe more, right? But earlier, probably less, okay, with inflation over time. So, you know, those inventory amounts are not the correct number, are they? But then what do we do? What we want to do is get an estimate of how much the inventory really cost me at LIFO. Okay? So I'm going to bring them back down to base year dollars. What do I mean by base year? I select a year, start the business maybe, right? I select a year that's going to be my base year, okay? And I say those costs are 100% of the base year, right? They're at 1.0, 100%, right? What it costs me. And then I keep track of how much inflation I have year after year after year based on some price index. Maybe retail price level, right? Consumer price index. More likely a wholesale price index. Maybe a price index for my industry. Got the idea? Okay? And I keep track of how much inflation I have each year. Okay? So then I can take the inventory back down to what it would have cost me in the base year. Everybody got the idea of that? So I deflate the inventory back down to the base year. But then the problem is, some of that inventory I bought in the base year with LIFO, right? I keep the old stuff. But if I increased my inventory year to year, some of it I bought in the first year after the base year, some I bought in the second year, third year, and so on. Got the idea? So I'm going to have these layers year after year after year building. Well, those I bought in a different year when the price index was at a different level. So I reinflate those layers. And then I add together the inventory I bought in the base year, inventory for the next year, the next year, the next year, add them all together, and guess what I've got? My inventory at year end. And I've got all my different layers. Now, why did we do all this nonsense? Because I don't want to keep track of the layers of inventory, really. I'm just estimating what they are. Got the idea? It's really important to understand what you're trying to do here before you start computing it. Otherwise, you just kind of, why would I do this? Okay? Why do you want to use LIFO instead of FIFO? You guys read about this. You guys know about this. What happens? In fact, towards the end of the chapter, they talk about, on page 445, take a look at that real quick. This evolving issue, well, I don't know if it's evolving, it's been around a long time. Repeal LIFO. Why would people want to repeal LIFO? Every time we elect a new administration, I mean the presidency, right? They get all excited about maybe we could repeal LIFO. And then business says, whoa, 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 whoa. What's the deal if they repeal LIFO? What did they say here in the year 2009? The death of LIFO, Journal of Accountancy. How much additional tax dollars would have been collected at that time? $61 billion. We suppose the administration would like to collect $61 billion? Yeah. Congress would like them to collect it too, except they don't want to lose all the votes from all their constituents, right? Okay. Usually the White House is pretty good about it, particularly in their second term, because they can't have a third, right? Everybody got the idea? So politically, this is really a hot potato. But what about LIFO anyway? Is that allowed under international accounting standards?
No.
No. So are we going to repeal LIFO so that we can adopt international standards? The Convergence Project? No. We don't have to do that. Could we adopt the standard and not have LIFO on financial statements? Yes. All you'd have to do is allow a difference between book and tax, just like we do for depreciation, and that's probably where we're going to go. They're not going to get rid of this LIFO exemption, because some companies would owe massive amount of taxes. Which companies would owe a lot of taxes? Companies with a lot of inventory, right? Okay? Because what's the deal? They're using LIFO, and their inventory is real low, which then did what? Made their net incomes year after year less, right? Because it made their cost of goods sold more, right? Made their inventory less, their cost of goods sold more, their retained earnings less, but it also made their tax bill much less, right guys? Okay, so that's the deal here, right? Anyway, so at that time it was 61 billion. What do you bet it's a lot more money now? 2009 to 2016, yeah, it's even worse, right? Okay, bigger difference. Okay, anyway, so let's do, maybe what we'll do is we'll do a problem. One of the exercises is on LIFO, dollar value LIFO. Let's take a look at that. How would we calculate it? This is a good thing to get down. I'll find one. Anybody remember which ones they were? E823, 824, 825, 826. I suggested you do all of these, didn't I? Okay, so 23, 24, 25. Let's do 25. Okay? So here's exercise 825 on page 459. Presented below is information related to Dino Raja Company. And so what they've got is, for each of these year ends, they have the year-end prices and their price index. Which one's the base year, you suppose?
2011.
Yeah, the first one, December 31st, 2011 is 80, okay? And then we have each of the other years. So what do I want to do? First, I want to get down to the base year on all of them, okay? So here we go. Let's give this a shot. I've got at 2011, 12, 13, 14, 15, 16, okay? Year-end cost, okay? This is a cost, not a retail. We're not doing retail yet. This is a cost, right? So my inventory was 80,000 in 2011, which is my base year, okay? My inventory is 115.5 in 2012, but what's that? That's at the end of 2012 when the price index is 105. Okay, got it? So what would that have cost me if I had bought it in the base year? All you have to do is deflate, right? Divide the 115.5 that it would have cost me at the end of the year to buy it, right? By the 1.05, because it costs $1.05 to buy what would have cost $1 in 2011. Got it? 2012 it cost 5 cents more, right? That's it for anything, 5% more. So what would it have cost me in the base year? That's all there is to it. Divide it by the index, in other words. So my costs have gone up 5%, so what would it have cost me in the base year?
110,000.
110. They made the math work out really nice. By the way, what's 80 divided by 1.0, of course? It's 80. You're in the base year, of course. It was, not, it's what it would have cost. Okay, what it did cost. All right? So now what happened? LIFO, last in, first out. I assume I sold everything new I bought and kept the old stuff, right? So what do I have? I have 80 from the base year, plus I have what? New layer is how much? The new layer is 110 less 80 is 30. Right? That's a new layer in base dollars. Everybody got it? Base dollars. It's just the add-on. So the first one was 80 in base dollars, and then I got 30 more, right? All I did was I just split it out. Everybody see what I did? 80 from the first year, 30 from the new year, 110. Big deal. But now what do I need to do? Reinflate it, okay, to get my inventory, okay? What's it going to be? The 80 was obviously a 1. You don't have to divide by 1 and take it times 1. It's okay with me if you just put the 80 all the way over there. Funny, right? That's a joke. So I got 80,000 from the base year, okay? That's from the base year. Base inventory. LIFO layer. So there's layer 1. Got it? Okay? Then what do I add to that? 30,000 new layer, but what did those cost me? 1.05, right? So what's 30,000 times 1.05? What would that be? 31. 31. Ta-da. What's my inventory for 2012? We know what 2011 was, right? It was the 80,000 to begin with. What's 2012 inventory? Looks like 111.5. That's the answer. This is easy, isn't it? Okay, let's do 2013. Okay, what was the year-end cost? 108. Guess what? I'm going to deplete a layer here. How do I know that? It's even less at year-end cost, isn't it, than the year before? What's the cost index now? 120. Oh, I depleted quite a bit, didn't I? So what is it? 90,000 this time? So it would have cost me $90,000 in the base year, right? What is the 120? That's the inflation for the first 2 years, right? It includes the 105, right? Includes the 5% from the first year and then another 15% for the next year. Got the idea? Now it costs $1.20 to buy what it would have cost, would have cost $1 in the base year. Everybody good? Okay. So what do I do with that? When did I buy it, you guys? Be careful. What do I have here? What does that consist of? 80 from the base year, right?
Yep.
Times 1, of course, is 80. And then what else do I have? I only need how much? 10 more. And when did I buy that?
12.
I bought it in 12. What about the stuff I bought in 13? You must have sold all that. What about the other stuff that I had from 12? You sold that too. What did I keep? The oldest stuff. It's LIFO. Just remember you're doing LIFO, you got it made. So what would this be, a 105? So what's 10 times 1.05? 10,500? So what's the ending inventory at 2013? 90,500. Another way you could have done it is you could have looked at what got depleted. What got depleted? What LIFO got depleted? 20,000 went away. Everybody agree with that? 30 less 10? 20 went away at 105. How much is that? 21,000, isn't it? What's 111.5 less 21,000? 90,500. Boom. Either way is just fine. You can take out what you got rid of, right? Or you could just calculate what you have left. Either way is just fine. I don't care. Okay? Can't get it. Line up for that. That's 500. Okay, so 14. What's 2014?
122.2.
Okay. What's the price index at that time?
130.
1.30. Cost $1.30 to buy what you could have bought for $1 in 2011. What's 1.3 divided into 122.2?
94,000.
Nice of them to make the numbers turn out good. What are you going to have now?
80,000 for the base year.
I'm going to keep 80 from the base year and
10,000.
10 from 2012, right?
Yep.
So I've got 2000, I've got base 2011, and I've got 2012 layer, and nothing from 2013, right?
Right.
Everybody agree?
Yep.
And now what am I going to have? I'm going to have a 2014 layer, aren't I? Because I can't get the 13 back, it's gone. Everybody agree with that? So what's this new layer? How much does it have to be? If you've got 80 plus 10, that's 90. It's now 94. How much more do you have? 4,000. Everybody like that? But I bought those when the price index is 1.3, because that's what they would have cost back in the base year, right? The reason I'm going down to the base year is so that I can estimate what it would cost now, okay? So what do? I take it times what? 1.3. How much is that? For 2014.
5,200.
5,200. So what's my inventory going to be then at 2013? The two old ones plus the new layer, right? I got a 2011 layer of 80. I got a 2012 of 10.5, and I got a 2014 of 5,200. Just add 5,200 to the 90,500, don't you think? How much is that? 95,700. One of the things I really like about this is it really helps you build analytical skills, keep things straight. And can I see something? Can I understand something? And then can I crank out the numbers on top of it? Boom, it's really nice. Okay? Your employers are going to love it. When you start doing basic inventory stuff, but you could have done this, oh man. Right? Or if they actually use dollar value LIFO and you're the only person that they've hired in years that can do it, right? Unless they hired somebody else from Bellarmine, right? In this region, they know you can do it. So, all right. Be shocked at some of the places. We had 2 kids get invited to Deloitte's International. Who are they anyway? Hunter and Emily. You know how many kids got invited worldwide? 300 and some? Yeah. What are the odds, Bellarmine? We graduate 30 people a year, you guys. How many thousands worldwide? Jeez, I don't know. 100,000? I don't know. We have 2 of them, really? I remember the time we got our first one. Well, I don't know. You guys are pretty small. Nobody knows who you are, but we can try. How come we got 2? Because they've hired some of our people and sent them to their headquarters. And they're really good. None of you guys are going to be any good, but maybe next week. Yeah. You never know. Yeah. You know what? They're both dumb shits. You guys know them, right?
Yeah.
They're just dumb shits like you guys. That work real hard, right? Work real hard. Oh, and they went and met everybody too, didn't they? They went to every single accounting event, didn't they? Some of you guys do that. Some of you guys don't. Who are they gonna hire? Oh, who's gonna get noticed and get sent for something like that? By the way, do you think they might get a full-time internship offer? Every single person who goes to that is gonna get a full-time internship offer. Of course they are. That's why they're having them go there, because they want to talk them into working for them. Wouldn't that be a nice situation to be in? They want to talk you into working for them instead of you talking them into hiring you. Work, you guys, work. It really pays off. And by the way, do you have to spend your career with Deloitte because you go to work for Deloitte? Of course not. Does it look good on your resume? But then so does Chilton Medley. They like me to say that. Now I'm fixing Chilton Medley because they get mad at me. They think I promote big four firms over large regionals or over large locals. Not really. I could care less where you go to work, right? But get everybody to hire you, and then pick who you want, right? Instead of praying somebody hires you, right? Don't put yourself in that position. Let's do the 2015. What was the total?
154,000.
Even?
Yep.
What's the index?
About 140.
What would that have cost in base year? Divide 1.4 into 154. What do you get?
110,000.
110. Did they add a new layer? Yeah. Now I've got the 80,000 in base year dollars, right? From 2011, which is 80,000. I've got 10,000 from 2012, which is at 105, which is 10.5. I have 4,000 from 2014. How much do I have from 2013? None, right? Because I depleted it during that year. Okay, 4,000 at 130 for 2014 is 5.2, and how much more do I need?
16.
Looks like 16,000 to me. And what did they cost? 1.40, right? $1.40 per dollar. Okay, so for 2015, what's the layer for that year? 22,400. How much am I going to add to get now all those years together? 95.7 plus 22.4 is how much? What are you going to have on your balance sheet, in other words, 2015?
118,100.
118.1, is it?
Yes.
All right. And in 16, what happened? I don't know why they're building their inventory so much, but they are. 16, it's what?
176.9.
176.9. What's the index, everybody?
145.
What's the base year then?
122.
Oh, for crying out loud, they added another layer? They need some inventory management. Actually, maybe not. Maybe the company's growing. They have more stores and that kind of thing, right? So, more locations. So what did they add? Another 12. All right. What did it cost?
145.
And what do we have? This is a 2016 layer. How much is that?
17.4.
So what would I do? Now I want them all together. 8,000 plus 10.5 plus 5,200 plus 22.4 plus 17.4. Just add the 17.4 to the 118.1. And what do you have at 2016?
135.5.
Okay, I want to add one more thing to it because I don't like the way this problem finished out. Okay? Let's do this. In 2017, I adopt new inventory methods. I streamline everything just in time maybe. I drive my inventory down to $120,000. And my price index at that time is 1.5. Do it. What would that one be? Did I deplete some inventory? No kidding. Wow. In year-end dollars, I'm clear back less than 2014. Right? And I have a price index of 1.5. They're going to be tiny, isn't it? I bet I got rid of a whole bunch of layers. So do that. Divide 120 by 1.5, of course. What is that number anyway?
180.
Whoops, not times, divide.
That's
It's what?
80,000.
It's 80, that sounds better. All right. Okay, 80. What I got rid of?
Everything but the first one.
Everything with the first one. I keep the first layer. There's 80 up there. Everything else, all those other layers are dead, right? They're gone. Just like that. Okay, I didn't mean to do that. Okay, let's say it had been, let's make it 140 instead. Say it had been 140. Do that one for me, just to make sure you can do this. Divide it by 1.5. It's not 80 anymore. What is it now? 93,333. Value the inventory for me. That's in base year dollars, right?
Yeah.
Base year in 2011 dollars. What would you do?
We would have 80,000 for the base year.
I'd have 80 from the base year. I'd pick that up. So the base is 80.
And then
That's 2011.
Yeah.
10,000.
I need you need how much? 13,333?
Right.
Which ones?
12.
I've got a layer that is what left? It was 30, but then what did I do to it? I deleted it down to 10, right? Depleted to 10. So I'll have 10 from 2012. But what was that 10? So this is 80,000. This is 10,000 in base dollars, right? What is it at year-end dollars?
10,500.
That was 10.5, wasn't it? So now I'm up to 90,500, but I don't have enough. What do I need? I'd like something from 2013. Is there anything? Or 2013.
No.
No, we skipped that year, didn't we? So what do I have to go to? 2014. How much was in 2014? 4,000, but I don't need all of it. How much do I need? 3,333. Because this has to total how much? 93,333 in base year dollars, doesn't it? But what do I want to inflate that 3,333 at? What was the index that year? It was 1.3, wasn't it? So take that times 1.30, and what do you get?
43,333.
4,333?
Yeah.
Is that right?
42,333.
4,000. Yeah.
4,333.
Yeah.
Yeah, okay. What do those three add up to?
I'm not sure.
You guys, can you get this right? Yeah. Make sure you can do this, because then the retail method we're going to layer on top. It's going to be retail and dollar value life. So we're going to adjust for changes in retail price, and then we're going to adjust for changes in cost too. Both of them. Okay? So we got a bunch of other stuff to do. Make sure you've done all the problems for this chapter when I see you next time. And ask me to work any ones you want. Okay? There are a few things in this chapter. This one's pretty easy. The next one's a bear. Okay?
This one's a bear.
Yeah. This one's not too bad.
I feel like every single time
Frank
we
through.
not that bad. We have a hard test. Okay. And then when it's easy, or
Well, that's because I'm afraid to give you some hard test on hard material because you won't get anything right.
Now, our next test, we get on a Monday, right?
Do we?
I think so. I mean, if we could change that to Friday, that would be great.
yeah, I kind of like that.
I love Mondays. You know why?
Well, we get it on Monday and then
Because I want you guys to work on it over the weekend.
Well, no, we
Why do you
get
like
it on the
Monday?
Monday and we have it till Friday.
Oh, it's take home. Oh,
Yeah.
yeah, we'll work that. We'll figure it out.
Oh, okay.
That's not an. I give it to you on a Monday and I want it back Wednesday or something.
No, we want it back Friday.
I want it back Friday.
It's still weird.
That's clutch.
Still hard though. Yeah. That might be, but is it the last one? Well, that's
The last
the
one.
finals coming up. I'd give you the money to give it back, but then I can't get it graded for you. That's the rub.
I think there's some time, maybe not.
Yeah, we got some time before the finals. We got a week before the finals. We could probably do that. Yeah. We'll talk about it.
Yeah, I think the last week of class is all time for you.
Yeah. This is such an easy class, isn't it? You know, everything's so relaxed.
Oh.
Did we get our history class?
Yeah.
I hate when you say
I remember coming in
You're
and
not
doing,
allowed to.
I was late or something. I was like, hey, here's mine.
2:15.
Is it easier than 2:15?
I'll let 2:15.
Really?
You like
Well,
that one?
that wasn't good.
I'll tell you what 2:15 is. I think I'm doing better in that class than I am in this one, but then I actually do good. Yeah, I'm doing a lot better.
Good.
to talk about that after.
Things are.
Yeah. Just because of what I had to, actually went to Delaware for a bit. My,
Oh, it's
both
late.
of my,
Unless you
I have
did
like, my dad's.
or at least I've never gotten an hour.
So it's not like my mom's side left, and, but I have two uncles that like,
If you get
like
like one of
the
the post
family,
like 50 or
and one just about
That's when you get
and the other one got cancer.
Hey,
Same week,
Oh.
like at the exact same time. So I had to go down there and like, we just, we put him in the house in Florida.
The one who's going to tell us how to know about the one with cancer or something?
No, he just, it was, he's like, he's a pilot, brilliant guy, and it's just something tweaked. He was like the most stable guy before that, and then just something happened. So what happened, like, I had to, we just bought a place in Florida near the house where we're keeping him right now. He's in like a home for, so we had to go down to Florida and get like a little place there. So, just like a month, we can go whenever. And then the other one, he's just in a, he's in a hospital right now for the cancer. So it's just kind of like it happened on the exact same week. So I had to, they haven't, my mom started to reach my parents over in Europe. It was like there for some time, so it was kind of just, I needed to go.
Well,
But I, that,
options. You could get a heart draw with all that stuff. You go to David Collins and lay it out for him, what's going on, and send you an email and ask how you're doing and all that, not just telling you, yeah, get a heart withdrawal. What are you doing this summer?
I'm working in New York
Okay.
at an internship. I mean, I don't mind, just studying my butt off for the final and doing
See what happens.
and see.
What you could do is.
I honestly don't mind. I know I need to do some work. I have no problem with that.
Well, we could see how it goes. You know, I mean, it just puts lots of things in your mind.
Yeah, which I don't mind. I mean, I get this stuff.
When are you supposed to graduate?
Not next year, but a semester after.
Okay.
I'm doing one semester after.
You could do this in the fall. The worst thing that would happen is you get a grade that, you know, on your transcript. Have you ever replaced a grade here?
No.
No, okay. If you take the class a second time, they leave the other class listed, and they list the grade, but they don't compute it in your GPA.
Okay.
So your GPA is only the new class.
Okay.
So if you got a D, okay, right? The D shows in your transcript, but then if you got an A next semester, next fall when you take it, you got an A,
Okay.
right? And that's what computes your GPA, and everybody knows that. It's not a big deal.
Yeah.
Right? It doesn't matter.
Yeah.
That's the worst outcome. That's what happens, right? The advantage of dropping it is you don't have that grade on your transcript.
Yeah.
The other thing I could do is I could give you an incomplete when we're done. You could decide not to take the final. I could give you an incomplete, and then you clear the incomplete by taking the final. And the way you do that is you study the whole class again in the fall.
Yeah.
And then you get, you know, get the incomplete cleared with the grade. The risk of that is if you never clear the incomplete, it automatically converts to a math.
Yeah, so that is
Yeah.
for something like that.
And if I were you, I wouldn't do that. Because let's say you got a D and you decide, well, I'm not going to replace it. You know, I'm not going to retake it. Well, so you have a D in your transcript, including your GPA, but at least it's not math.
Yeah.
And you can't graduate.
So
Yeah.
Yeah.
So I think I just let it go, especially with your attitude. If you want to work, you know, go for it.
I think I can do it for the I just was hoping I could have it put on for the final, just because I was out for a while.
Oh, we just add the points.
Yeah, and I'm fine with them right there. I'll
Yeah. So you'll just have a massive final.
Okay.
Because you missed a few things. So,
Yeah.
Okay.
Fine with me.
And, you know, just let it fall where it does.
Yeah.
It's too bad you can't do the class in the summer, but if you got a full-time internship with that.
That's what I'm saying. I have work figured out for my life after, so I just need to complete. I just have to graduate.
Don't let yourself do that.
Oh, no.
You know what I mean? Don't check out early. And I don't mean to consciously do that, but you can subconsciously do it.
Yeah.
Well, you know, I know what I'm doing, I know where I'm going, and none of this stuff really matters. Yeah, it does. Plus, if I were you, I'd use the credits to become a CPA no matter what you're going to do.
Yeah.
Because you put those three letters after your name. So, and when they're sorting through resumes and throwing them away, they don't throw yours away.
I usually don't get it.
Yeah,
no matter what else
For
you
some
have.
reason, I shoot with the
Yeah, I did my resume already for the whole thing, but it's like after the internship, when I find something else that I want to do, then it's good to add it on.
And either, but it's just like long straight.
Yeah, you know, what are you gonna be doing in New York?
Well, I have two different things. I'm either going to just on Wall Street,
Mhm.
which is the main one, just because of the family who's worked there for so long. It's easy to do that whole project.
Yeah, either way, good deal. I still have CPA.
You would? Because I was talking
Because
to Ron.
it's just a few more classes.
Yeah.
And
I also
take a
have to
little
do
quiz.
stuff different
Big deal.
because the CPA requirements in New York or wherever I'm at might be different. I heard.
Could be, yeah, but not
So,
much, not
okay.
much. You might have another class or something you need to take before they'll certify you. Same exam.
Yeah.
It's the same thing. Yeah.
And he also said instead of the CPA, it might be good for me to take it's like a something financial.
CMA,
Something.
no,
CFE.
CFM.
CFE.
CFE, yeah. There's a variety of them.
Yeah.
You can have as many letters behind your name
Yeah,
as you
you
want.
got a bunch of crap. Thing about CPAs, everybody knows what it is. So you don't want to, okay, what were those letters again? Yeah. There's the CFM, the CFA, you know. CFA, CFE, CFM. Certified Financial Manager, Certified Financial Analyst, Certified Financial Examiner. Yeah.
Okay. Yeah.
Yeah.
I
It
just want
depends
to let
on
you know
which
what's
one's
going on
preferred.
though.
Okay.
So I don't
Cool.
like. I mean, it was kind of something. I
Well,
had to
after
do.
this, you gotta do 212, right?
Oh yeah.
313.
I got that next semester.
Yeah.
No, usually around.
Okay. Yeah. Well, you're gonna, yeah,
I-
well, let's see how this one comes out. Yeah.
Yeah. Yeah.
Okay.
Okay. Thanks.
Good deal. What are you doing? You're sick?
I have been. I was sick all Easter weekend.
Oh, that's good for you.
No, it's not. And then
It's
going
like
back to work.
that.
You know, it must be the middle of tax season. I'm going back to bed.
Really?
Yeah.
Yeah.
Are you having fun? Did you work today?
The library. I was gonna ask you something, but I don't remember.
What were you gonna ask?
I don't remember. I'll text you if I remember.